Hello and welcome to the Quality Investor. This is part 2 of what the super investors bought and sold in Q3 of 2024. I want to jump right in to the discussion today. So if you want to check out the introduction I did in part 1 of this series, that is linked below and it will be linked at the end of this video. We are discussing 4 more super investors. We're starting with Pat Dorsey, followed by Terry Smith, Chuck Aker, and finally, Bill Gates. But before we get into it, please like this video and subscribe to the channel. It only takes a second, helps us grow, and you can stay on top of all the quality businesses in the market. So let's jump right into it with Pat Dorsey of Dorsey Asset Management. Pat Dorsey uses a single long-only equity strategy. He was also very instrumental in developing the economic moat ratings while he was the director of equity research for Morningstar. It is the methodology that Morningstar uses to analyze competitive advantage. So he has a very concentrated portfolio, currently owning only 12 stocks at a portfolio value of just under $1 billion at $642 million. Pat Dorsey has a pretty impressive track record. On a 1-year basis, he's returned 58%. On a 3-year basis, a little above flat at 3%. But on a 5 and 10-year basis, he's returned 16% annually, far outpacing the S&P 500. His largest holding is Meta Platforms, followed by AutoZone, Wix, and his newest buy, AppLovin Corp. So if we look at what he did this quarter, you notice he trimmed each of his positions by roughly 3%, except for 2. Smartsheet, he sold down by 40%, and SEM Rush Holdings, he sold down by 40% as well. But none of this was to take profits. If we look closely, he had a single buy that accounted for 91.2 million of the portfolio value. He bought AppLovin Corp, 698,796 shares to be exact. And it's already turned out to be a very good investment. The reported price of his buy was at $130.55. The current price of AppLovin is at $333.31. He already has a 155.31% return. So it looks like he trimmed a little bit from each of his positions, selling down big in Smartsheet, which I tend to agree with this decision on Smartsheet. I've used the product myself, and I can say it's nothing really special at all, but he's going all in on AppLovin. I don't know that much about AppLovin, but I do know that there's a lot of excitement surrounding their AI-related advertising business model. You notice too, he also has a small position in Google. So Meta Platforms and Google are very big players in the online advertising market. Well, AppLovin is also part of that competitive environment. However, they are indirect competitors with Meta and Google, but now he owns a very large portion in Meta, AppLovin, and then a nice chunk of Google. In general, he has a lot of online tech-heavy assets, Wix.com, PayPal. He had a lot of Smartsheet before he just sold that. But he's also a big shareholder of AutoZone. I was actually just at AutoZone this past weekend for windshield wipers. All in all, a very concentrated portfolio, and his big buy of AppLovin, it actually has me intrigued, and I think I'm going to do a little bit more research into this company to see what kind of competitive advantage it really has. Remember, Pat Dorsey was instrumental in developing the framework at Morningstar for analyzing companies' competitive advantages. Next, we're looking at one of my personal favorite investors, Terry Smith of Fundsmith. His performance on a 1-year basis is at about 17%, but on a 3-year basis, it's pretty much been flat. On a 5-year basis, he's returned 7% annually, and on a 10-year basis, he's essentially matched the S&P 500 at an 11% annual return. Terry Smith is known as the Warren Buffett of the UK, and in his portfolio, it is made up of stocks that are highly reliable, stable, growth-oriented businesses, all of them with very wide economic moats. His biggest holding is Microsoft, which he reduced by about 3.37%. And we can see here That was a major theme for Terry Smith throughout Q3 of 2024, reducing many of his positions. His largest reduction on a percentage basis is McCormick & Company, a spice company. He reduced by 82.8%. He also reduced Philip Morris by about 17%. All in all, looking at his portfolio here, it looks like he trimmed a little bit of each position, possibly taking some profits. He did not counterbalance that by making any huge, significant buys. He added a little bit to IDEXX Laboratories, a little bit to Google. But other than that, it looks like he might be prepping for something going down the road, stacking some cash for possibly further buys in the quarters ahead. So nothing too exciting from Terry Smith in this quarter. However, I do love the construction of this portfolio. I believe it's a very well-balanced portfolio with high growth-oriented tech stocks, as well as very stable consumer stocks. We have the Microsoft, Meta, Googles of the world, along with some very stable, boring companies, ADP, Visa, Pepsi. So we'll see if my thesis proves true in the next few quarters, if there's any big buys coming down the road for Terry Smith. Next, we're looking at Chuck Aker of Aker Capital Management, another investor with a very impressive portfolio. He's very concentrated at 18 total stocks. Chuck Aker focuses on high-quality businesses with very wide moats that he believes will compound returns for his investors over time. Chuck Aker's performance has been nothing short of spectacular, returning 26% on a 1-year basis, just 5% on a 3-year basis, but 11% annually on a 5-year basis, and 14% annually on a 10-year basis. MasterCard and Moody's lead his portfolio, both incredibly high-quality companies. And if we look here, there was another theme of selling in this quarter. He sold Moody's, reduced that by 20%, sold KKR & Co. by 16%, sold CarMax by nearly 40%, Digital Bridge by over 63%. So a lot of big sells in this quarter. However, it looks like he counterbalanced those sells with a pretty large buy in his portfolio, and that is Airbnb. Clearly, Chuck Aker sees something in the home sharing business of Airbnb. And to give a bit of foreshadowing, I might be mentioning Airbnb in a video upcoming later this week. But Chuck Aker clearly sees something in this business, and the fact that he's adding such a large amount to his portfolio means that he sees the consumer not slowing down their traveling much in the near future. But I also think in the long term, he really believes in the business model of this business becoming dominant in the hoteling industry. So again, a very strong portfolio of very strong wide moat businesses, and it looks like his action in this quarter was all in the service of the big buy of Airbnb and then as well as CC Intelligent Solutions. And finally, we have the Bill and Melinda Gates Foundation Trust, the stock portfolio that manages Bill Gates' enormous Microsoft wealth. Now, this portfolio is in the service of various charities. However, it has actually underperformed the market over the last 10 years. It's down 12% on a 1-year basis, and it's only returned 6% annually the last 3 years, 6% annually again the last 5 years, and only 7% annually over the last 10 years. Microsoft is, of course, his largest holding, $12.4 billion of this portfolio value in Microsoft, and his second largest holding is Berkshire Hathaway, his good buddy Warren Buffett's business, with a $10.2 billion holding in that company. And in this quarter, he had 3 significant sells out of his top 3 positions, reducing his Microsoft position by 17%, his Berkshire position by 10%, and his waste management position by 8.5%. However, these appear to be in service of 2 large buys. He increased his FedEx holding by 65%, adding $273.6 million to that business. And he also made a significant buy of nearly $100 million into PACCAR, a competitor of both Caterpillar and Deere, which Bill Gates owns here, the 5th and 6th largest holdings in his portfolio. PACCAR, of course, is a Seattle-based construction equipment manufacturing company. He bought 1 million shares there, again at 98.6 million. So it looks like he reduced his largest holdings in order to buy a lot more of FedEx and into PACCAR. It'll be interesting to see how FedEx performs over the next few years, as they've been losing ground to both Amazon distribution and UPS. So while Bill and Melinda Gates Foundation has a portfolio of very strong corporations, it has not performed up to the expectations of some other super investors, which I find interesting given that his largest holding is Microsoft, which has well outperformed the S&P 500 over the last 10 years. And same with Berkshire, another outperformer of the S&P 500 over the last 10 years. But his focus doesn't appear to be on pure growth plays, but a lot of highly stable businesses in general. We have Canadian National Railway, Caterpillar, Deere, Walmart, FedEx. None of these are world-beating businesses, but they all offer steady, reliable growth, albeit slow growth. So the 4 investors that we reviewed today, Pat Dorsey, Terry Smith, Chuck Aker, and Bill Gates, all appeared to have a lot of sells in this quarter, but it seemed to be in the service of adding significant amounts to key holdings in their portfolios, with the exception of Terry Smith, who looks like he trimmed a little bit of his positions to take some profit, maybe stack a little cash for the future. It seems like these super investors are making big bets on some businesses going forward. So that wraps up my look at the Q3 buys and sells of the super investors. Stay tuned later this week. After Thanksgiving, I'm going to be posting a video that discusses the 5 types of economic moats, what they are, and examples of businesses that fall into each type of economic moat. Thank you for watching today's video. And if you've made it this far, go ahead and subscribe to the channel. Thank you and happy investing.